Joining us now is Mr. Robert Linton. He's a senior portfolio manager, also director of marketing, mergers, and acquisitions for Strattners, which is a hedge fund. Robert, welcome back to the program.
Hi, thanks for having me, Don. Good to be here.
Well, you get some new titles added to your portfolio manager title. You're a busy guy.
Yeah, well, it was kind of things I was doing already anyway, so it just seemed appropriate to have the title. So it better describes what I do for the company and what I can do for other companies that work with us.
Well, tell us about Strattners. As we mentioned, it's a hedge fund.
Sure. As a hedge fund, what we do is we provide financial services for companies and individuals as well. Kind of one of the things that makes us unique is rather than taking cash as investments for the hedge fund, we take stock. So we work a lot with companies that are newly formed OTC companies that are looking for a fast track to the NASDAQ. So with that being said, a lot of the founding shareholders, the company wanting to, say, do an equity line so they can raise money for their business model, we are able to take the stock from the founders, register stock through S1s where we can use it in an equity line and essentially manage the transactions, place the stock. We are a international company based in Dubai, so we have great banking relationships around the world, which allows us to place stock where a lot of companies in the US traditionally have difficulty doing that. So by being able to manage the founders as well as the company's interests, it helps the company have a smooth transaction into the stock market without any adverse effects to the stock for people, say, liquidating or something like that. So it's very streamlined and efficient for everybody involved. And then the people are able to deposit the stock by purchase agreements through our company. And that's essentially how we're funding businesses. We work with them as well in the marketing aspects. We arrange things for them to communicate with their shareholders, whether it be by helping with certain website designs and things of that nature. And we do it as more of a third party to help the company align themselves with the proper people to do things most effectively.
Well, of course, accessing the capital markets is the main reason these companies go public. But at the same time, the CEO's primary responsibility is protecting shareholder equity, correct?
Yes, exactly. And we make sure that we're doing that, because if a company wants to be on the OTC, you kind of have a couple of directions you can go. You can not be successful in your business plan, in which case the companies don't succeed. But we really work with companies that have a very solid foundation for what they're looking to do to go forward, so they can get to that next tier of the NASDAQ or just a higher exchange. And when you do that, because the way we make money is by being able to fund companies, because we're making percentages based on that. So for us, we have more of the long sight of being a long-term partner with a company and its shareholders so that they can be successful and then we're successful. We have some registrations of over $100 million. And, that's kind of the target that we want to get to. We understand initially companies aren't necessarily in a position to even need $100 million. But if it is, say, 5 or 10 million to get started, and then with the plans of expanding and having a business model which is scalable and can grow up, those are the relationships that we like to build so we can provide a service for them for the long term.
Well, you have a unique perspective, Robert, because you have sat in the CEO of a public company's chair before. That must give you a little bit of an advantage.
Yes, it really does, because I'm very familiar with what works, what doesn't work, with the challenges involved with public companies, whether it be something like DTC eligibility or FINRA or whatever their filings with the SEC, all of those technical aspects. I have a very good understanding because as a CEO of a small public company, I had to do a lot of the stuff myself, basically, which I chose to do it because it would save money, and then just have the lawyers look at it after to make sure it's okay. So I'm very familiar with that. I'm also familiar with what makes a company successful in the public markets, because a public company not only is about making revenue and being successful, it's about making your shareholders happy. And shareholders are a lot happier when they buy a stock at $1 or invest that into the company and then have it worth $3 rather than having it worth 10 cents a few years later. So you have to be smart in how you do all of these elements. They all have to align and work together to push the company forward. I think I've said this before. It's not build it and they will come. It's build it, let people know you're going to have the event, and then they will come. So you really have to cover all of the bases. And if you're doing that and you're doing it in a smart, effective, clear way that the shareholder community understands it, then you will be successful. But you take one element out, the chain is only as strong as its weakest link, and then it doesn't work. So we work with the company and advise them to make sure that they understand all of these principles so that they can be successful, and in turn we are successful.
What would you say is the biggest mistake small companies make when they're looking for financing?
Biggest mistake is being desperate, needing convertible note money and taking it from multiple sources. And in the short term, it may seem great, but then they get stuck because once the notes mature and they have multiple people in the market, then each one of them is trying to sell it. And the general nature of a convertible note, it's called a toxic note for a reason, because it's advantageous usually over, say, a 3-week period for when the people convert their stock. It's advantageous to them to have the price go down at some point during that period, because then their next conversion is based on that lower price. So it has a toxicity built into it. And if you have multiple people doing that, and then they can see in the market, because these stocks don't have huge volumes, when they can see a lot of trading and they see a trend going down, if they've converted their stock, let's say they converted it at $1 and they suddenly see the price going down, they don't want to be the ones selling it at 90 cents. They want to get out of it. So now you have multiple people in a market selling it, pushing their price down. Then everybody's getting unhappy. The people investing are unhappy seeing the price go down, and it has a negative effect. So that's why I think it's most important, whether it's working with us or somebody else, stick with one person who can provide you all the solutions to get to the level you want to get to. Because whenever people are selling stock, everybody's pointing, it's him, and it's not effective. So if it's working with one group, you know what's going on. You don't know what's going on in the market, because the more shareholders you have, you can have tens of thousands of shareholders, and you don't know who's doing that, of course. But you don't want any toxicity built into your structure of how you're going to finance it. And that's what we are great for, because the whole mission is for the company to be more successful, get to that higher tier, get to a higher price to make sure that they can get to the NASDAQ and stay on there.
The company's called Strattners. It's a hedge fund. Robert, great insight. Thanks so much for joining us.
Thanks for having me, John. Always a pleasure.